Hey everyone, welcome back to The Explainer. Today, we are jumping straight into a massive, historic geopolitical crisis that is actively reshaping the world as we know it. We're breaking down the events of May 2026, mapping out the immense global economic fallout from this escalating US-Iran conflict. We're going to unpack the complex supply chain shocks, the soaring inflation metrics, and the urgent pivots that corporate finance leaders absolutely need to make right now. Okay, let's just dive right in. Picture this. It's Sunday, May 17th. And that fragile diplomatic truce we'd been watching, it's officially over. U.S. President Donald Trump drops a severe public ultimatum on Truth Social, literally warning that the clock is ticking and telling them to get moving, fast, or there won't be anything left. And alongside this rhetoric, there was this really aggressive AI-generated imagery depicting the president and a U.S. Navy admiral against stormy waters, with the ominous caption, "It was the calm before the storm." These statements and this deployment of synthetic psychological warfare imagery fundamentally shattered the precarious ceasefire that had been holding since April. To really understand the velocity of this crisis, we need to walk through the timeline because things deteriorated incredibly fast. It's like a domino effect. Back in February 2026, the kinetic conflict, dubbed Operation Epic Fury, kicks off, causing the biggest oil supply disruption in recorded history. By April, Pakistani mediators managed to broker a fragile ceasefire. But then, mid-May hits. On May 16th, the U.S. lets the General License 134B Russian oil waiver expire, instantly squeezing global energy markets even further. And just one day later, May 17th, talks completely break down, we get that presidential ultimatum, and a major drone strike hits UAE infrastructure.
So here's our roadmap for the Explainer today. We're moving logically from the geopolitical epicenter all the way out to the actionable micro-level corporate strategy pivots you need to know about. First, the ceasefire collapsing, then paralyzing the Strait of Hormuz, the macroeconomic earthquake, fractured alliances, the corporate strategy pivot, and finally, extreme market volatility.
Section 1. The fragile ceasefire collapses, maximalist ultimatums, and asymmetric retaliation. Now, what's really interesting about this diplomatic deadlock is just how fundamentally incompatible these demands are. Both sides have dug in with maximalist positions. The U.S. is demanding that Tehran hand over 400 kilograms of highly enriched uranium, permanently restrict their nuclear ops, and unconditionally reopen the Strait of Hormuz. On the flip side, Iran wants every single U.S. and international economic sanctions lifted, frozen assets released immediately, and a permanent halt to U.S. and Israeli military operations before any substantive nuclear limits can even be discussed. There's literally zero overlap in these primary demands. The diplomatic track has completely exhausted itself. And of course, when diplomacy collapses, physical escalation steps right in. Also on May 17th, a targeted drone strike hit an electrical generator right outside the inner perimeter of the UAE's Barakah nuclear power plant. Now, thankfully, emergency diesel generators maintained power and there were no radiological leaks, but wow, what a massive physical warning from Tehran to U.S. allies in the Gulf. It's a textbook example of asymmetric retaliation. They are basically signaling that any resumption of the U.S.-Israeli bombing campaign will result in devastating strikes against the critical energy and civil infrastructure of nations supporting the blockade. Moving on to Section 2, Paralyzing the Strait of Hormuz, the weaponization of global maritime trade. So, rather than indiscriminately mining the waters, the Iranian regime instituted what they call a professional mechanism. In practice, though, it's a formalized extortion system designed to systematically manage and weaponize global maritime trade. Under this strict regulatory regime, access is highly conditional. Any commercial operator with ties to the United States or the U.S. Navy's Project Freedom escort mission is explicitly blocked from entry, no exceptions. And for the non-aligned vessels that are actually allowed to pass, get this, they're facing a staggering transit toll. Iran is currently demanding mandatory fees exceeding $1 million per commercial vessel. They're extracting this under the guise of specialized services and mandatory maritime insurance policies. You combine that massive fee system with sky-high war risk insurance premiums, and a strait that normally handles 20% of global seaborne crude is essentially unnavigable for standard operators. Which brings us to Section 3, a historic macroeconomic earthquake, inflation, yields, and energy shocks. Let's talk about the sheer physical deficit in global energy markets right now because it is staggering. We hit an unprecedented peak price of $1,838 per ton for global aviation fuel during this crisis. With over 14 million barrels per day of Gulf oil production shut in, the world has literally lost over 1 billion barrels of crude since the conflict began. The structural premium for finished products has widened dramatically, sparking flight cancellations and a really aggressive inflationary spiral in global freight costs. And that energy shock, it is bleeding straight into the bond market. Persistent inflation fears, fueled by national retail gas prices breaching the $4 mark early in the conflict, have completely evaporated any hopes for near-term Federal Reserve rate cuts. The Fed's been forced to hold steady, and this hawkish, higher-for-longer posture has violently pushed the benchmark 10-year U.S. Treasury yield past the 4.5% threshold. Naturally, that global yield spike connects directly to consumer finance. The average 30-year fixed U.S. mortgage has jumped up to 6.37%. Economists are noting that this sudden massive spike in the cost of capital has effectively frozen the anticipated spring housing recovery. Prospective buyers are just paralyzed by affordability constraints right now. It's a true macroeconomic contagion, and we're feeling it in every single sector. Let's zoom out a bit for Section 4, Fractured Global Alliances, BRICS Division, and Transatlantic Friction. When we analyze the BRICS coalition, the divide is really striking. On one hand, you have China maintaining relative neutrality because their economy is structurally insulated. They are buffered by massive strategic petroleum reserves, the world's highest penetration of domestic electric vehicles, and deeply discounted Russian energy. Contrast that with India's acute vulnerability. Relying heavily on seaborne crude through the Arabian Sea, India is in a full-blown crisis right now, with black market cooking gas prices tripling. And that vulnerability was severely worsened when the U.S. let that Russian oil waiver, General License 134B, expire on May 16th. That removed a critical supply valve and caused immense friction among Asian importers. Section 5. The Corporate Strategy Pivot, Actionable Advice for Finance Leaders. So, the crucial point here is that finance leaders have got to rewrite their traditional playbooks and adopt maximum agility. We've got 3 actionable steps derived from current market insights. First up, accelerate hedging. Just hedging for the upcoming year isn't going to cut it. Companies with commodity exposure are swiftly locking in future costs using 2026 swap contracts. Second, pivot your funding. Public debt markets are frozen by geopolitical risk, so corporate treasuries must expand relationships with private credit markets and syndicated loans just to secure dollar funding. And third, maintain CapEx discipline. You absolutely must preserve cash and defer non-critical expenditures, but, and this is vital, do not cut investments in structural innovation like high-margin operational efficiency tools and AI. Those provide a necessary deflationary buffer, so keep funding them. Finally, Section 6. Extreme market volatility, reallocating the institutional portfolio. Top-tier investment banks have mapped out the spectrum of risk, and we can clearly delineate 2 major forecasts here. The base case assumes the conflict persists as localized attrition. The Strait stays heavily restricted, Brent crude hangs in the $100 to $115 range, and we see a minor 0.2 percentage point drag on global GDP. But the severely adverse scenario models the launch of Operation Epic Fury 2.0. That means full-scale strikes on Iranian subterranean facilities and Kharg Island. In that scenario, we're looking at Brent crude soaring to a catastrophic $140 to $160 per barrel, triggering a massive 0.4 percentage point drag on global growth, vastly increasing the probability of a synchronized severe global recession. So, how do you handle that level of extreme volatility? Strategists recommend completely abandoning the highly vulnerable traditional 60-40 portfolio in favor of an equal-weight defense strategy. You want 33% in inflation protection. Think integrated energy majors and tips that actually benefit from supply shocks. Another 33% goes to structural innovation. We're talking mega-cap tech and AI companies with fortress balance sheets that command valuation premiums. The final 34% should be anchored in safe haven assets, physical gold, the US dollar, and short-duration credit, keeping you insulated from those extreme long-duration yield spikes. Which leaves us with this final, really critical question. How is your organization adjusting H2 2026 forecasts in light of these sustained supply chain shocks? The landscape is shifting daily, and staying rigid is simply not an option anymore. I would absolutely love to hear how you and your teams are navigating this historic volatility, so please share your strategies. Thank you so much for joining me today on this explainer. Keep learning, stay focused, and I'll catch you on the next one.